I am investor and publisher of Digest Publishing and Daily Profit Cycle, Nick Hodge. No, you're not seeing things. I am on my own this week. We are without our fearless co-leader, co-host, Mr. Gerardo Del Real, who is out sick this week. So you're stuck with me and soliloquy, as it were. I'm going to keep it short and I'm going to keep it structured. I'm not going to rant about the news or anything else random that comes to mind. I am going to respond to some reader questions or comments that have come in. And so we're going to talk a little bit about batteries, and then we're going to talk a little bit about share structure. So the first question is from a gentleman, or a comment, I should say. The first comment is from a gentleman who's been writing in for the past couple of months because, we've been talking a lot about lithium batteries and how lithium is entrenched and how there's not enough raw materials in the supply chain being developed to support all these battery factories that are being built. And this gentleman has been incessantly writing in telling us that we're wrong, that we have our eye not on the ball, and that we're missing out on some spectacular new batteries that are being developed. And I won't dispute the fact that obviously lots of new battery technologies are being developed, from solid state batteries to flow batteries to different chemistries, even in the lithium sphere. So what I will say, though, is that those batteries aren't ready for the prime time yet. They're not yet commercialized, and they're certainly not being adopted internationally by global multi-billion-dollar companies, battery or auto manufacturers, and being used in the way that lithium-ion batteries are. So right to the comment here, he says, "Hello, Nick. You are busy, too busy, I think. There are new batteries that do not require lithium or copper or uranium. In fact, one battery requires water and provides electricity while extracting nitrogen and expels pure water, then recharges in the time it takes to pour more water into the battery. Seconds. Another battery, called the Forever battery, is a solid-state battery and can power a phone all month and then be recharged in a minute. It does not burst into flames if its casing is breached, and if something else is burning and the battery case is opened, for example, in a car accident, the water puts out the fire." He goes on to tell me about a new liquid battery as well, where you can drink the electrolyte, which I'm sure he saw in a newsletter promotion video. This battery does not explode. It does not eat its cathode, he says, while being charged or discharged, and you just simply have to add water to charge. You can find more data on each, which billionaires are funding mass production against Elon's beliefs. So let's take these as they came here. Let's talk first about this Forever battery, which is a newsletter promotion that's been around for a while by Mr. Charles Mizrahi, who I used to be a coworker of back in my previous publishing life before he left and went over to the Agora affiliates. And Mr. Mizrahi has had this Forever battery promo out for a while now. It's been running. I just got this information from Stock Gumshoe, who deteases all these newsletter promotions, including ones that Gerardo and I put out. So the Forever battery is being made by a company called Blue Solutions, which was public and then was taken back private by a French group called Bolloré. Excuse my French there. It's not very polished. And those batteries are quasi-commercialized, but they've had problems of their own. Gumshoe goes on to say in his report that Paris was using them in so-called blue buses because the company, again, was called Blue Solutions. And a couple of them caught fire, despite what our commenter said. He says it's a solid-state battery that doesn't catch fire yet. They were catching fire on buses in Paris. So they suspended the use of their blue buses. And again, these aren't commercialized batteries. And so the second one he was talking about there was a liquid battery. This is also from a newsletter promotion. We've mentioned, in fact, on this podcast before by Miss Naomi Prins. And that's a company called ESS Tech with the clever ticker of GWH. to stand for gigawatt hours, which is how battery manufacturing facilities are, ranked by their size or how they're quantified, I should say. That company, the liquid battery company, is a company called ESS Tech under the ticker ESS. And it came about through the SPAC craze in 2021, which you should know those SPACs start at a $10 price and then are valued in the market once they're de-SPACed, once an asset is put into the special purpose vehicle. And this one started trading in the second half of 2021, quickly ramped from that $10 base price all the way up to $28, and since then has skied downhill and to the right to a low of $1.70 some just this week. This is a company that is making grid scale batteries, or is attempting to, but their forecasts for revenue last year were $3.5 million. My companies and Gerardo's companies make more than $3.5 million, and we're a small mom and pop shop. So this is in no way, beginning to dominate the global battery race. In fact, it has continued to lose money. We'll lose tens of millions of dollars this year. And that's not to say that the tech doesn't work, but it is to say that it hasn't been a great investment. And the investments that we've made in lithium itself have far outperformed, some of these battery and EV companies that are being pounded really hard by other newsletter editors in their letters and in their promotions. In fact, in this case, you would have lost a significant amount of capital if you were putting your money into ESS Tech. And that's why, by and large, we go right to the source, right? We go to the elements or the metals and the minerals that are going to be needed to make these batteries. And so a couple of points I wanted to make there, which I know I've made before. So sorry if you've heard me talk about some of this stuff. But the first thing is, and this comes from a presentation given recently by Simon Moores of Benchmark Mineral Intelligence, who has his finger on the pulse of all the battery factories that are being commissioned, developed, built across the world, and the inputs that they're going to need. And so I made some notes just to get through this quickly, and then we'll get on to the second question. So there's 350 battery gigafactories being built in the world right now. These are lithium battery gigafactories. Of that 350, some 140 are built but aren't at the giga level yet, so they're being expanded to the giga level. For the production of those batteries that are going to come out of those 350 gigafactories that are being built, 70 to 80% of the cost is now in the minerals, metals, and chemicals that are needed to produce those batteries. So that's the lithium, that's the cobalt, that's the nickel, that's the graphite. And that's just what it is. That's the lithium battery is the chemistry that, global auto manufacturers have decided on, whether they're getting their batteries from, a CATL, or whether they're getting them from Panasonic, or whether they're building them themselves like Tesla. They're all lithium batteries. They're not forever batteries. They're not liquid batteries, to relate back to the gentleman's comment. And then so according to Benchmark Mineral Intelligence, there's going to be a capacity of 5,000 gigawatt hours of battery production capacity by 2035. That's up from 750 gigawatt hours today. So a 7x, as Mr. Moores describes it. So to sate or to meet all the need of the minerals for that 5,000 gigawatt hour capacity that's going to be built by 2035. I might have said 2050 a couple of minutes ago, 2035, which is a short 12 years away, by the way. We'll need 59 new lithium mines at 45,000 tons per annum each, and we'll need 72 new nickel mines at 42,000 tons per annum each. And then he goes on to say in this recent presentation that by 2050, mining and refining needs $3.5 trillion of investment to meet the demand for all these metals and minerals that are the inputs for these batteries. And so far, there's been about $100 billion committed. So a ways to go to get to that 3.5 trillion. So yes, I'm busy, but I do keep my eye on the ball, and I look at these other battery technologies, and I look at the other chemistries that are being developed, for example, and at some point there will be a shift, especially for the grid scale batteries, the flow batteries, etc. But we're not there yet, and when it happens, believe you me, I will be there to put my dollars in what I think will be the winning technology. But as it stands right now, as it's stood for the past couple of years, the lithium battery is where it's at, and the components that go along with that have been the place to make money. The graphite companies, the nickel companies, and certainly the lithium companies from the first run in the 2016, 2017 timeframe, which I was a part of and was out visiting, the lithium flats in Nevada, and Gerardo went down to Argentina in that time to check out another company. At both of those companies, we ended up making good money on. Both were acquired. One was Lithium X, which was my first big win in the lithium space, some 1,400 or 1,500% winner. And Gerardo was down in Argentina visiting Advantage Lithium, which was taken out by Orocobre, which is now called Allchem. And so we've been in the space for a bit. We've kicked tires. We put our feet or boots on the ground. And then all the way up to this recent, 2020 to 2022, up to present day, sort of the second wave of lithium, which has seen, the price of lithium carbonate rise several times over in China, and the world start to realize that there's simply not enough of these inputs, to make all these batteries that we've globally committed to doing. And it's evolved much further from, just the lithium triangle in South America and Nevada, and hard rock mining and spodumene mining in Australia, to lots of other projects, particularly in Canada and the James Bay region, that are now offering spectacular drill results for lithium spodumene bearing pegmatites, and where battery companies are setting up shop, where auto companies are setting up shop in Quebec to take advantage of that. So that's it on batteries for me. Let's go to the second question or comment here from Mr. Sean G, who has written a couple of times, and was provided one of the impetuses, or impetus plural. Anyway, he provided the impetus for our discussion on private placements a couple of weeks ago, and how to get started, how to qualify as an accredited investor, what to look for when you're interested in doing private placements. And he had a follow-up question that I'll read right here. He says, "Hey, Nick and Gerardo, I was blown away that you answered my question on Bizarro World, as I'm a huge fan of both of you. The episode a couple of weeks ago was especially enlightening. You two dived into private placements. It was really cool to hear how you both really got in the game. I wish that you would explain how share structure works, how you differentiate from a company with a profitable share structure from one that is totally diluted. I could Google it, but I would rather hear it from two professionals who live it. What do you look for when it comes to how a company sells shares? What are indicators that make it a good share structure as opposed to red flags?" And I'm talking from the standpoint of most of us that have to buy in the open market because we don't meet the qualifications for being an accredited investor. If you've heard me and Gerardo talk, or read some of our reports, or subscribed to our letters, particularly the private placement ones, a Junior Resource Insider or Hodge Family Office Private Intel, you'll know that share structure is one of the first and most important things we look at when evaluating a company. It depends on the stage of the company, but let's talk about, I guess, a couple of different stage companies. If it's a very early stage company, one that's pre-IPO or about to IPO, we look for not just the share count, but at what price they sold those shares and to whom they sold those shares. Um, it, One of the tropes, or one of the conventional things that promoters do, especially on TSX and TSXV listed stocks, is issue themselves, quote unquote, cheap paper. That is to say, they sell themselves shares at a penny or 2 pennies a piece when the company is formed. And in this way, they can get themselves millions of shares at a very low price because they're only priced at a penny or 2 pennies each. And then they go out, go to their family and friends and perhaps raise money at 5 cents a share. And by the time it gets to, I guess, groups like ours, groups like mine and Gerardo's, they might be raising money at 10 or 15 cents. The problem is that that's sort of like building your house on sand, right? Because once it comes to trade, you've got a lot of cheap shares out there that can erode the progress. And human nature is such that, if you've sold yourself shares at a penny or 2 pennies, and it comes trading at 15 cents, I mean, you've already 10 or 15 bagged your money, right? And so you're going to be selling, and it creates an overhang that the stock isn't able to ascend through or poke through because you've got these cheap shares being sold into the market. Staying on the early stage companies, the other thing people do, you asked about red flags, is they don't register their shares in their name. And what I mean by that is there might be a certain amount of shares out. And yes, the insiders own some and have registered them in their name, but then they have shares that the market doesn't know about, that they don't have to publicly report on, because if you're a true insider, you have to report when you buy and sell shares. But, if they put these shares in some other vehicle, in a wife's name or a relative's name or in some numbered company that doesn't hold above the threshold for reporting, then they can be, as an insider, is selling those shares and not having to report that to the market. So, one of the things we ask for is it's called a capitalization table. And you can ask this of any company that you're going to be potentially investing in. So I want to see the full cap table, the full capitalization table. I want to see every share that you've sold, at what price it was sold, and who owns it. And the company can provide you that. They have a share ledger, right? And if they won't, then that's another red flag, because they certainly have it. And then let me read these questions again. So I guess that's how we would look at the share structure, from, one that's good, that allows a company to succeed, versus one that's totally diluted. And in Sean's words, speaking of totally diluted, and now I'm talking more about companies that are already trading, not pre-IPO or about to IPO. You look at their share count. That's one of the first things I look at. If somebody tells me about a new stock, I go to Stock Watch or whatever, and I look at the share count, and then I go to their slide deck and I see, where are those shares? The problem, once you get above, there's no concrete number, but once you get into the 80, 90, certainly above 100 million shares out, is the share structure becomes a bit squirrely, right? It gets tougher to keep track of where all those shares are. It's tougher to clean the stock up, is the phrase you hear a lot, to say that, if shares were sold at a previous level, that they've all been accounted for, or they've all been, the stock has been above that price for so long, so they've likely cleaned up and aren't selling anymore. But even more than that, what happens is you start to dilute yourself, which is what Sean mentioned there. It doesn't afford you the opportunity to make a mistake or to have a miss if we're dealing with exploration, because exploration is very expensive and is often unsuccessful. Certainly not all drill holes hit, and so you have to drill more, and that requires more capital. And when you get into these higher share counts, it becomes all the more dilutive then to fund the company again, to add to the share count, to dilute it down. And then you sort of get on a treadmill, right, where you end up having to roll the stock back or consolidate the shares. What else do we look for? What do you look for when it comes to how companies sell shares? what makes a good share structure. And then the other thing is insider ownership, right? I talked about, wanting them insiders to have the shares in their name, but you also want to look at who else owns the shares. I guess I was going to look at a company here called Bravo, which we've talked about a couple of times, and maybe we can throw the slide up here when it comes to the section so you guys can see what I'm talking about. This is a company that has 100 million shares out, no warrants, which is something I should mention. Warrants are future dilution. Companies have to issue warrants to sweeten the pot when they're raising money because it entices investors or it convinces investors to put money in the company because it allows them optionality in the future or leverage in the future if it does work out. And in my experience, the lower quality of company, the worse terms it has to offer from a share structure standpoint, either a full warrant instead of a half, or a lower price warrant, or a warrant that has a much longer duration. So you have an overhang of those warrants for longer. In Bravo's case, no warrants issued, right? It's 101 million shares out, no warrants. They were able to raise all their money, tens of millions of dollars, by the way, 40-some million if memory serves, early last year with no warrants. And then who owns those shares? Well, 2/3 of them, 62% or so, are owned by the board, fully reporting. BlackRock, the financial behemoth BlackRock, owns another 10%. And then there's two other institutional groups that own another, it looks like, 13.5% or so. And then there's other strong hands, including Rick Rule, Sprott, and a group called RCF that own another 1, 2, 4, call it 5.5%. And so at the end of the day, there's only less than 10% of shares available out there for retail to trade. So when you hear about a tight share structure, we're always looking for a tight share structure. That's the term that we use. It's not necessarily just share count. It's also at what price were they sold? Are there warrants out? How many warrants? What are the price of the warrants? And then who owns these shares, right? With, management with 2/3 and institutions with another 20-some percent. Those are strong hands, right? Those aren't going to be people who are in the market selling stock, right? They're in it for the long term. They're in it to let the company execute on its goals. And they'll likely, participate in future financings. And that's another thing to keep in mind when you're looking at share structure. Who are those investors? And are they in it for a flip, to make a couple pennies per share times however many thousands or millions of shares they have? Or are they deep-pocketed, strong-hand groups that will continue to fund the company as it hits its milestones and needs more capital? Those are the best types of shareholders, right? Because not only are they not selling, but they'll come back and invest more without flipping the shares, without selling shares to participate in a new financing, which you see a lot of times in these smaller companies, right? You have shareholders that own stock, and when it comes time to fund the company again, they're selling the stock that they have to participate in the next financing, and that's another one of those treadmills. And I guess that's a pretty good summary on share structure there, the things we look for, what makes a good share structure, etc. Again, we encourage you all to write in either in the comments of the YouTube videos or by contacting customer service at digestpublishing.com. We love to hear from you, whether you're a subscriber or not. We love to talk shop, talk about the markets, talk about the things we look for when evaluating companies. And we would, of course, like to have you as a subscriber. So that's a pretty long soliloquy there, 25 minutes or so by myself without Gerardo. I hope that was insightful for some of you. I hope some of you wanted to learn about share structure. And as always, like we say, like, comment, share, subscribe, and we hope these videos are useful for some of you. Have a good week out there, everybody.
Hey there, you independent-minded investor. If you like this video, make sure to tell us so by clicking the like button below. Subscribe to our channel so you never miss another one. And share it with everyone you know on social media. You can also click the link in the description below to check out more information-packed videos just like this one. Thanks for watching.